Being a real estate investor means that you get to have fun tax deductions. But how do we actually use those and what does that mean? That is what we are diving into today in this episode of the Lady Landlords podcast. Today, I have an expert that I will be interviewing, Thomas Castelli here from Hall CPA. Thomas, thank you very much for joining our episode today. How are you doing today?
I'm doing very well. Thank you for having me. It's a pleasure to be here.
Our Lady Landlords community asks more questions about accounting, finance, tax deductions, benefits as a real estate investor than probably any other topic after the actual landlording that we do when we own rental properties. So I am happy to have you here to break down just some of these myths and hopefully give us some insight into some things that we as investors don't necessarily think about that you as a CPA probably have always running through your mind. So thank you very much for your time. I am looking forward to diving into today's episode. But first, I always just like to start with just who our guests are kind of behind their professional responsibilities and their connection to real estate. Why don't you just take a second and just share a little bit about who you are outside of your role as a CPA?
Yeah, absolutely. So I'm Tom Castelli. So outside of real estate, I'm pretty much like how can I break this down, right? Because this is the first time I've answered this question on a podcast in a while. So I live in Miami. I grew up in New York. So New York, born and raised my entire life. But Miami has a beautiful lifestyle, no state taxes, of course. So I decided to move down to Miami. So when I'm not doing like the real estate CPA stuff, I'm doing some kickboxing. So I do cardio kickboxing, taking golf lessons, trying to work on my swing so I could be competitive on the golf course. Sometimes involved in some charity events and things like that to support usually veterans or rescue animals. But that's kind of I like to hang out with friends occasionally. That's kind of who I am outside of the whole CPA world. I do like to read a lot of books, so I'm always having an audio book or a book or a podcast that I'm listening to when I'm at the gym or something like that. And I'm big into fitness. I have a Porsche Boxster that I like to drive on the weekends that has a convertible rooftop, which is nice to have here in Florida. But that's me. I mean, a big premise, a big part of my life is the professional version of my life, which way back in 2012, maybe it was, I started getting into personal development, personal learning. I started listening to or reading books like Rich Dad Poor Dad, The Richest Man in Babylon, a lot of these foundational books that really kind of set me on the trajectory. I want to not only build wealth for myself, but eventually, help other people build wealth. And I think I get to do that in a roundabout way by being a CPA and helping people reduce taxes, which is one of their largest expenses. So I spent a significant amount of the last probably 15 years looking for ways to help people build wealth and reduce their taxes. So that is such a big focus of my life. I've really haven't fully articulated who am I really overarching beyond that. But I hope that answers the question.
Yeah. And also, I think it's really interesting when people really have a passion for what they do, that who they are versus what they do is actually kind of synonymous. And it sounds like in your situation, that is such a big piece of who you are as a person. So
Yeah.
it makes perfect sense. I always like to ask this, did you want to be a CPA as a kid? Like, where did that come up for you? Like, how did you end up in this industry?
Yeah, so when I was a kid, I remember sitting at my grandmother's house. I distinctly remember this. I was 5 years old, and I was telling my mom, I'm going to be in business. Like, that's what I'm going to do when I'm older. So there's always a business thread, and kind of growing up, I'd always find myself doing like little entrepreneurial things to make money. Like I ran car wash. I went door to door knocking doors to tell people car washes, landscaping, things like that. I used to like host garage sales where we'd sell stuff. I had eBay stuff going on for a bit. There's always been something that I've been doing. And when it kind of got time to go to college, I like was not going to go to college. I was like, I don't want to do this. There's plenty of people out there who have success in business who never went to college. But everybody around me, including high school guidance counselors, parents, friends, were all going in that college direction. And I kind of felt very compelled to go there. So my mother was a bookkeeper. My aunt was a CFO of a company, and they were always telling me, go become an accountant. Go become an accountant. You want to be in business? Go become an accountant. And then kind of when I got into college, I started community college. The guidance counselors or what have you there said, if you're going to get a degree in business, it's got to be either accounting or finance because those are the business degrees that are going to be valuable for you. So I went and got my degree in accounting and started off at BDO, which is a very big firm. and quickly realized. So that's how I got into the industry as an accountant. It's kind of like through just the process of through like the idea of being in business and then kind of just the powers that be or influences that I've had at the time when I was a young adult kind of guided me into that. And that's how I got here. But like beyond that, like while I was in college, I started learning a lot about real estate and kind of realized I wanted to kind of focus on the real estate path of things. So while I was in college, I actually started getting involved in community events that had to do with real estate and fell upon this group that got into real estate syndications. And what they did is they had a 3-day coaching weekend where they broke down the business of real estate syndication, raising capital, how to do apartments, how to underwrite apartments, how to source them, so on and so forth. That I really fell in love with that model and started going to their meetings, started kind of going along that path, invested with somebody as a limited partner who kind of was like my mentor, kind of showed me the back end of that business model. And he said to me, "Hey Tom, if you go find an apartment community that makes sense, we'll go ahead and syndicate it. We'll actually make it happen." So I started calling up people, networking, yada, yada, yada. Eventually uncovered an apartment community that made sense for what we were looking for. And we ended up syndicating that deal. So I say all of that because this was so intertwined with, this is how I became an accountant, but also there was around along that same path in parallel is also how I got into real estate. So then I realized after working at a very big accounting shop that, hey, look, corporate accounting, not really my thing. I want to be more small business, real estate oriented. And that's kind of how I fell into where I am at today. But yeah, that's how I got into the business.
Very cool. I always just like to see, and maybe because I didn't really have like a direct focus and now I'm just a real estate investor full time, I always just find it very interesting how people ended up in professions who just kind of had like that lifelong dream versus who it just happened to be a bunch of circumstance after circumstance that got them to that place, like myself. So I always like to ask that question. So in there, you mentioned about the idea of previously working at a larger firm, then wanting to work with small businesses. I feel like on our side, as a person that uses accountants, it can be very confusing. As a real estate investor, do I need just someone that can prepare my taxes? Do I need
Mhm.
somebody that's a tax strategist? Do I need somebody that's actually a CPA or an accountant? What is the difference between those terms? And as an investor, at what point should I say, H&R Block and TurboTax isn't really cutting it for me?
Yeah, so this is a nuanced question. So a tax preparer is someone who's going to prepare your tax return and file it with the government. That needs to happen for people making money in the United States. Otherwise, the IRS doesn't come after you. So if you just have a job and some brokerage statements, you're probably fine with TurboTax. You're probably fine with an H&R Block. Even go as far as to say if you're an accidental landlord and you happen to have a property that maybe your primary residence that you now just rent out and you move somewhere else, and you really don't have plans to actually build a real estate business or really expand your portfolio with like one or two rental properties, you could probably still get away with an H&R Block or a TurboTax. But once you start saying, hey, I want to become a landlord, I want to build a business around it, that's when you really want to start looking for somebody who specializes or at least has a deep expertise in real estate because things get vastly more complicated when you enter into real estate because real estate's a business at the end of the day. And the tax code as it relates to real estate is actually it's one of the more complex areas of the tax code. So if you're just working with an H&R Block or a TurboTax to do your taxes, you might be missing out on deductions or strategies that they're not aware of because they're just not in that realm or in that niche to understand what's available to you, right? So I'd say once you kind of make the commitment to become a landlord and you have like 2 or 3 properties, is when you probably should start looking at, hey, should I get a specialist or someone who has deeper real estate expertise? So that's when it comes to tax preparation. Next level up is bookkeeping. It goes hand in hand with tax preparation. With the government, when you file your tax returns, you need to file accurate financial statements on the tax return, right? So you need to have the bookkeeping in order. So probably if you have like 1 or 2 rental properties, you could probably do the bookkeeping yourself on a spreadsheet and you'll probably be all right. But as your portfolio begins to scale, not only does the bookkeeping become more complex, but it's going to take more of your time and energy. And that's something that, unless you're a professional bookkeeper, is probably not the highest and best use of your time. As a landlord, the highest and best use of your time is finding more deals, managing the deals you have, the rental properties you have, and making sure your portfolio is optimized. And then on top of that, maybe whatever else you have going on, whether it's a job or business, that's the highest best use of your time, not bookkeeping. So you probably want to get a bookkeeper at some point after a handful of properties just to kind of keep that organized. You'll be able to find tax preparers who will be able to do the bookkeeping for you too. But then there's tax advisory. Tax advisory is okay, great. your taxes are filed, great. But what are the strategies? What are the opportunities, deductions, and credits that you could take advantage of to really optimize or minimize your taxes from that angle? Most CPAs are not going to provide that level of service to you. All right. See, bookkeeping and tax preparation, that's you can find that in a lot of different places. But tax advisory is more of a niche specialty. And that's something that you want to take a look at again. Once you start committing to this as a business or a side endeavor that you're going to be doing, you want to start getting those specialists around you so that you're not leaving money on the table. And I'm sure we'll talk about what some of that stuff is today, but that's tax advisory. And then those are probably the three main things that we're looking at as an accountant is going to do for you. Then there's wealth management and financial planning. That's a whole nother animal. So yeah, that's kind of, I guess that's what a CPA is going to do. Those three things are the primary things that you're going to want to look at.
Thank you. And I try to let our ladies know and just have those conversations that when we're deciding that this is going to be something that we are going to use to build income, right? And like you said, not just the accidental landlord, it does become a point where we need the right people on our team. And I'm actually really happy that you mentioned bookkeeping. I cannot tell you still now how many lady landlords I talk to that own multiple properties. And I say, great. So how much money are you making every month? And they go, I don't know. And I said, well, are you making any money? I don't know. Well, are you losing money then? I don't know. That is not how businesses are run. We need to
Right.
understand our numbers. And also, we need to have the right people on our team, having an accountant on our team, having an attorney on our team.
Right.
These are costs. These are literally just normal business expenses to have an accountant and to have an attorney that you'd be
Mhm.
working with. So I'm really happy that you mentioned that bookkeeping there. So let's start with this. You get a new client that you're onboarding now as a CPA. They are a real estate investor. What are just some of the common mistakes that you see automatically from new investors that they just that in their taxes in the first 2 seconds, you're like, yup, of course they didn't do this or do this or do this.
Yeah. Okay. So there's a lot. So there's a few common ones, right? The first one
Okay.
is when you look at their tax return on Schedule E, which is where rental properties are typically reported when you own them in your personal name or through an LLC that is just you're the only owner of. People have missed simple expenses like property taxes, insurance. Like, I mean, the reason I'm saying this, these are expenses that if you have a loan on the property, you have to have property insurance, right? You're going to be paying property taxes. I don't know many places where you won't. And like, how are these missed on your tax return? Was it a failure on your part as the owner because you don't have the bookkeeping in order? So when you pass that information along to your CPA, it just didn't translate. They just didn't get it, or did they do something wrong, right? And why didn't your CPA ask you, well, why don't you have property tax? Well, where's your property taxes? Where's your insurance? Like these are common expenses. So believe it or not, we see basic stuff like that missed on a routine basis. It's kind of unbelievable. Then the next,
Question there. Who's at fault if there are things missing on a tax return? Is it previous CPA or is it investor?
so at the end of the day, it's all on you. It's typically on you as the investor. It's your ultimate responsibility, even if you pay somebody else to do it. Now, you might be able to legally have recourse against that person, but in the eyes of the law, like you're the end, you're the alpha and the omega. It's all on you, right? So it's on you. And oftentimes CPAs, we're just filing the information you give us, right? We're not obligated to ask you where are those property taxes. Now, I think as a professional, I would do that, right? But we're preparing the taxes in accordance with the law based on the information that you provided us.
And I'm pretty sure that's the statement that we sign
Yeah.
at the end when we submit our taxes. But thank you. But no, sorry. Keep going. What then? You had a couple other common mistakes that you feel
Yeah.
like you see.
So entity structuring, right? So LLCs, right? So I see a lot of, and we see this all the time, and we've talked about this ad nauseum out there, but putting rental properties in S corporations. Attorneys will sometimes recommend that. Not, I would say attorneys who are not familiar with real estate recommend putting properties in S corporations because they have strong asset protection attributes, I guess. And that might be true. I'm not an attorney, so I can't confirm or deny. But what happens is when you put a property in an S corporation, you can create a lot of tax issues for yourself down the line. Say, for example, that a property you buy it for $500,000 today, and in 10 years from now, it's worth 1.5 million. And then you're sitting down with your estate planning attorney and they're like, oh, we need to move this property out of the S corporation for estate planning purposes. If you move that property out of the S corporation, it's considered a sale. So now it's as if you sold that property for $1.5 million. Now you have a $1 million phantom in capital gain because you didn't actually sell the property, right? You did trigger a tax implication. And we see this all the time. One time it was a lender. The person had the rental property in the S corporation, And there's a few other activities they had going on with that as corporation. And the lender's like, we're only going to lend to it if if it's in its own separate LLC outside of that. So they had to remove it. And they bought the property in like 1996 or something like that. And this was like 2020 something. So it's just like they had it highly appreciated, and there was no way around, no good way to get it out. So you want to avoid S corporations for rental properties. If anybody's telling you to use one, there might be some special cases where that makes sense, but you should get a second opinion because it can cause you a lot of pain down the line. There's other issues around the S corporation, but that's the big one. Other mistakes. Some mistakes is people just think off the bat, I'm a real estate investor. I'm going to be able to use the losses to offset the income I have from my W-2 job or my business. That is antiquated information. It used to be like that before 1986, but it's 40 years ago. I know it's crazy, but
Right, that's before most of our listeners, owned property for sure, let alone be alive. So,
yeah, but
so antiquated for sure.
there's still some of those misconceptions though. It's still kind of linger on today. And like to do that, you need to qualify as a real estate professional or use like short-term rentals, which we can unpack. But that's just a mistake. People have the misconception of, oh, this is this big tax benefit. Or the other misconception is because they've already figured out that they can't do that, that real estate has no tax benefits. The real estate has a tremendous amount of tax benefits. So like that there's a kind of mindset misconceptions. But I'd say the deductions due often to a lack of bookkeeping and the entity structure are just two very common mistakes that we see on a regular basis.
Okay, I have a couple questions in there. So I'm going to go back to what you just said, and then we're going to hop into the next questions there. But you had mentioned about the idea of that business structure, right? Talking about how S corps, once again, can create other tax implications. In your accountant dependent, not being an attorney, but in your opinion as a CPA, how do you feel about properties being owned in LLCs versus people owning rentals in their own name?
Yeah. So from an accounting perspective, in most cases, it makes no difference, right? From a tax perspective, if you own a property in an LLC versus your personal name, if it's a single member LLC that's disregarded for tax purposes, it means it's as if the LLC is not there. It's going to go on schedule your tax returns. So you're going to get the same exact tax benefits that you would have gotten without that LLC. So from a tax perspective or accounting perspective, it doesn't make a difference. Now, where it does make a difference is when you have partners. Because when you have partners, typically you're going to be a partnership, or if you have a LLC, it's going to be called a multi-member LLC. So say, for example, me and you were partners and we went and bought a property. We're now going to have a multi-member LLC that's taxed as a partnership. We're going to have a separate file, a tax return for it. And there's going to be just some little nuances about how things operate. But even then, the tax benefits are still more or less the same. So from an accounting standpoint, having an entity doesn't really do all that much for you in a lot of cases.
Thank you. Attorney, very different question. So we have other episodes of the Lady Landlords podcast with attorneys about LLCs. So ladies, feel free to go back and listen to that. But this we're talking about just from that tax perspective there. Thomas, thank you. The next thing that you had said that I wanted to go back to for a second, real estate professional. Can you please define what that is and why that may be beneficial for an investor?
So let's break it down like this. So when you buy a piece of real estate, it's depreciated over 27 and a half years. That means every year you're going to get a little expense that you're going to deduct on your tax return that's going to help reduce the taxable rental income that you have. This expense only exists on paper. However, there are ways you can accelerate this expense and take like 100% bonus depreciation, for example, allows you to take 100% of the depreciation instead of over 27 and a half years of 5, 7, and 15-year property all in 1 year, which can sometimes be up to 25 to 30% of the property's purchase price. And when you do that, it creates a substantial tax loss. So you could have made money and put money in your pocket, had positive cash flow, but when you report it on your tax return, you're going to tell the IRS that you had a substantial loss. Now, by default, since 1986, real estate is passive by default, which means that that loss can only offset other passive income you have. For real estate investors, that's going to be other rental properties that you have, so other rental income that you might have, or potentially if you sell a property, you have a capital gain, those losses can also offset that gain. But you can't use that to offset your W-2 or your active business income by default. So the real estate professional status helps you unlock it, so to speak, so you can use it against your W-2 or your active business income. So that's the benefit. It allows you to take the losses from your real estate and use it to offset active income. Now, to qualify as a real estate professional, you spend 750 hours and more than half your total working time in a real property trade or business. So these laws are designed to the point where you basically have to be full-time, right, in it. So if you have a W-2 job, it's going to be virtually impossible for you to qualify. And that's backed up by dozens and dozens and dozens of tax court cases of people who tried and failed. So it's not like I'm just sitting here telling you not to do it. There's one tax court case where someone who was a part-time pilot who was able to fully substantiate their position that that was the hours on the right side for them. They were able to make it happen. But typically speaking, if you have a W-2 job, you're full-time, you're not going to qualify. So what we see sometimes there is you'll have a spouse. Maybe the spouse is working full time in real estate, or maybe the spouse can work part time and be that real estate professional. But that is how one path we see people to get there, right? But yeah, that's the real estate professional status and why it's beneficial.
I'm going to break that down and just make sure that I and our listeners all understand. So that phrase that we hear from a lot of investors saying, well, hey, I make a lot of money in my W-2, or I pay too much taxes in my W-2, so I want to buy real estate. And that way I can save on the taxes that I'm paying with my W-2. That really isn't a thing for the past 40 years, if I'm hearing you correctly.
That is correct. Yes.
Okay. Then that real estate professional status can help you off some of those expenses, but you would really need to have a marriage or a legally recognized partnership in order to have that happen. Because if I'm a single person and I work a W-2 day job, I really can't qualify for a real estate professional at the same time. I can't justify that amount of hours. Is that correct?
That's correct.
Okay.
Now, one thing I would clarify there though too, though, that is that just because you can't take the losses as non-passive doesn't mean there's not a tax benefit. And I think this is where a lot of people overlook, because once they hear, oh wait, I can't use the loss to offset my W-2 income, I guess there's no tax benefits of investing in real estate. There is. So with that depreciation expense, even though it might not be able to offset your W-2 income, it's offsetting the rental income you're generating. So you could be generating positive cash flow from the rental properties, but paying no tax on it. Now, in most businesses that you have, you're not going to have massive depreciation expenses. Yes, there's some businesses that are asset heavy where that will be the case, but in most businesses, you would just pay tax on the net income, right? And you're paid tax on the net income of the business at your ordinary income tax rates. But with real estate, that cash flow is sheltered from tax, which means you're increasing your income without increasing your taxes. And what that does is reduce your effective tax rate. I'll give you an example of what this looks like, right? Let's just say that say you're making $250,000 a year and you're paying, I'm just making numbers up here for the sake of example. It's purely hypothetical. And you're paying, let's say $100,000 in taxes, you were paying 40%, right? Now, let's say that you made $50,000 from real estate that was sheltered from tax. That's cash flow you put in your pocket, but you didn't pay tax on it. Now, all of a sudden, you're paying the same $100,000 in taxes, but now you have $300,000 in income. Your effective tax rate just dropped from 40 to 33%. So you are, in a sense, by investing in real estate, you're developing a more tax efficient income generating vehicle. So it's not all like, oh, I can't use the real estate professional status, this isn't worth it. It's a longer term game, and you're not going to maybe experience, oh, I got a huge refund this year, but you are moving your income into a more tax efficient source.
Gotcha. Thank you for clarifying, because I feel like that's still a very big misnomer in this industry. So I'm happy that we were able to discuss that. You also mentioned that when you talked about the real estate professional, you also mentioned that short-term rentals were a way. You said that specifically, that short-term rentals would be able to help some different setting of the W-2. Why short-term rentals compared to a mid-term rental or long-term rental?
Okay, so the Tax Reform Act of 1986 is where all of this stems from. That's why 1986 is a big year for this. They made all rental activities by default. However, hotels and motels are a little bit different, right? They looked at that as to be more of an operating business than a rental activity. So they said that if there's a few different criteria, but the one that's most relevant here is if your property has an average period of customer use of 7 days or less, then it's not a rental activity and it turns into a business activity. And with business activities, they're not passive by default, meaning you don't need the real estate professional status to take losses from a business activity. However, you do need to materially participate. Now, there's 7 different material participation tests. 3 of them are going to be relevant. The one that's most popular is going to be you spend more than 100 hours on that short-term rental activity, and no one other individual outside of your spouse spends more time than you. So, for example, if I had a short-term rental, if I spent 105 hours managing it throughout the year, that means, managing guest communications, pricing, all that type of stuff. And then I had some cleaners help, some repair people help. As long as those cleaners and repair people didn't spend more time than me, then my losses now on that short-term rental are non-passive. I didn't need to spend 750 hours. I didn't need to spend more than 50% of my working time. I just needed to make sure I met that test. And my short-term rental had an average period of customer use of 7 days or less. That for somebody who's in a full-time W-2 position is far more achievable and practical in many cases than the real estate professional status.
Right. But what's interesting, and I agree with that in the sense that, and I like my long-term rentals. I have long-term, short-term, midterm. I like my long-term better because I find that they actually take less of my time in a
Hmm.
different way. I feel like my short-term rental, I feel like I'm like a customer service concierge compared
Hmm.
to a landlord, which I feel like I very much am when it comes to my long-term rentals. So I see kind of that difference there of saying, hey, you're more active in your short-term rentals. Therefore, that's why you can do that in addition to the W-2 compared to the real estate professional, where that is then that full-time job with great for a person like myself, which is a full-time investor. But then you really can't outsource everything within a short-term rental business because you need to make sure that it's spread across multiple people
Yeah.
to actually get the work done. So that way they're not doing more work than you. So
Yeah.
interesting kind of options and balances that kind of have to take place there.
Yeah, no, no, for sure. And that's why these rules are written the way they were, because the government realized that, hey, you can make long-term rentals very passive. Not completely
Yeah.
passive, but very passive. And there's not that much effort that you're going to have to put into actually managing those. So what happens, that's how they basically circumvented it. Whereas with the short-term rental, it's an operating business at the end of the day. So that's kind of how they designed the rules was for that exact thing. So like people who want to make it all passive, guess what? You can make it all passive, right? But then you're not going to get the active benefit of the tax treatment. And that's the IRS understands that. Basically what happens is you need to be active. You need to be participating in these activities in order to get the benefits. And that's just how they designed it.
I think that was a great example talking about like hotels and motels. We've been picturing, especially now here in summer, I know you're from New York. I'm picturing, going down to the Jersey Shore. You can have an apartment where someone just gives you a key. You have to do your own dishes. You have to make your own bed. You have the apartment. You were just really supplied four walls, a little bit more
Mhm.
passive there compared to when you go to a motel where you have housekeeping coming in. You have concierge making sure that they're telling you where to go to dinner. Like it's a much more active place. You have turnover every other day. Every weekend is a completely different crowd. So I think that's a really great way to kind of think about how you can use either that short-term rental strategy versus then the real estate professional strategy if you're doing longer terms, which once again, think about that as an apartment versus motel. So
Right.
thank you. That that was a great rabbit hole that we went down. I want to kind of get back to one of the most popular questions that I see in Lady Landlords. And I guess I'll ask it to you this way, but what deductions do you feel that either real estate investors don't know about or don't actually use that they probably should be aware of?
That's a good question. Deductions. So, I mean, if you look at your Schedule E, you'll see all the deductions that you're typically entitled to. So, those are the common ones. Ones I think people often overlook is things like the ability to deduct a home office, potentially if certain requirements are met. The ability to deduct your vehicle mileage, or if you're using your vehicle more than 50% for your real estate business, you could depreciate your vehicle and get some substantial tax benefits through that. Other things that we see people miss are or see people overlook is the ability to pay your children through your business. If you have a child, you can pay your child through your business. You'll get a tax deduction. They'll get income tax free. They can reinvest that money into a Roth IRA if they wanted to and start their retirement account early or help fund their education. Multitude of things you could do with that. But those are some things that are beyond just the basics that I think some people overlook. And I would say these aren't necessarily deductions, what I'm about to say, but exit strategies. Not only can you operate real estate tax efficiently through all the ways we just discussed, but also when you exit real estate, there are tax efficient exit strategies such as the 1031 exchange. So some people just aren't even aware that you can defer taxes when you sell your property too, or you can defer it by
Right.
buying another property and using a cost segregation study on that new property in the same year you sold your property to offset the gain. So that's not necessarily a deduction, but that's something that people just often either aren't aware that works or that's even exists. But in terms of deductions, it would be those things that just go beyond the basics that I just mentioned.
Right. And I don't want to go completely down that path, but I love the idea of also employing children. It is not the sole purpose that I had my daughter, but I gotta say it was kind of in the back of my mind. Ladies, we do have an entire episode all about how to put your children on payroll. So I will link that episode down in the comments if you would like to go listen to that. Since we've already covered that, I want to make sure to hit other topics here with Thomas, but I'm sure a lot of women's ears perked up when you mentioned that. So, Thomas, that's a very big topic there. Great opportunity for a lot of the moms in our community.
Yeah, no, for sure. And I have one more that just came to mind. I
Yeah.
think that's worth mentioning. It's called the de minimis safe harbor. So when you are doing repairs or maintenance or capital improvements to your property, typically larger improvements and renovations do need to be capitalized and then depreciated over a period of time. But if certain components are under $2,500, so $2,500, and you have them itemized on an invoice, you could simply deduct those expenses on your tax return, which gives you a more immediate tax benefit, and that's a deduction. So that is something that I think people aren't aware of is the repairs and maintenance safe harbors, which is the safe harbor, the routine maintenance safe harbor, which allows you to deduct maintenance items that you didn't do every more than once every 10 years. And I think those are just two things people often overlook too.
Thank you. I want to stay with deductions for a second. That, once again, is one of those big topics that people are like, I want to take all these deductions. Yes, I'm going to buy a property so I can deduct everything. And once again, they always seem to think that that's going to make such an impact against their W-2. But there can also be some downsides to taking so many deductions. Can you talk about using deductions that actually impacts what your tax burden is? If, in your opinion, if there's any consequences to using too many deductions?
Yeah, it's a good question. So when it comes to real estate, I don't think there's many consequences around using too many deductions that you're entitled to take. I think some conservative CPAs or CPAs who are just scared or at very low risk tolerance will say that taking too many deductions could trigger an audit. That certainly audits can happen, but this doesn't mean you shouldn't take the deductions that you're entitled to, right? If you're entitled to the deduction, you should take the deduction, right? You shouldn't fear the IRS. Taking too many deductions that are not really deductions that you shouldn't be taking, now that's another story, right? And that's stuff where people, like say husband and wife partnership, every time they go out to dinner, they talk about dinner, right? And so every time they go out to dinner, they talk about business, right? Or they talk every time, right? And they start deducting that. That might get you into trouble, right? If every single meal you have with your spouse, because you mentioned the rental property, you're going to deduct, that can trip you up and run you into maybe a little bit of problems. If you're, trying to write off 100% of your business vehicle, but you use it personally, that maybe doesn't work out. There's a comment, pigs get fed, but hogs get slaughtered. That's the fine line. If you're entitled to a legitimate deduction, take that deduction. But if you're
Right.
if you're abusing the rules and you're kind of in that borderline space, is this a legit deduction or not? Sometimes you might be better off not taking it so far off the deep end.
I'm laughing because there's an Instagram profile and I do follow them because I'm waiting for like the day that his account gets shut down because he's arrested in a jail. But like all the things that you just mentioned, he like promotes himself as like a tax advisor and he's like, look, here's how to save all this money in taxes. Just like create an LLC, go out, take your wife to dinner, say, hey, yeah, we own rental properties, write it off. Buy a car, drive to your rental property, once a year, write it off. And I'm sitting there being like, dude, like you should not put this on the internet.
Yeah, that's the sensationalism of things. And I get it's good marketing, but at the end of the day, the best way I could look at this, you're running a business, right? And you're running a business. Is this a legitimate expense for the business, or are you just trying to write it off, or are you just trying to make it? A legitimate expense for the business is, the mileage you have to drive between you and your property, right? If you are trying to, write off, if you're trying to inflate the amount of miles you have or something like that, I'm trying to articulate what I'm trying to say. It's hard. What I'm trying to say is like, if there's legitimate business expenses that are legitimate to the operation of your business that are ordinary, necessary,
Right.
you need to have those. Then there's the ones that like, every time you go, like I said, every time you go out to dinner with your spouse, you write it off. That might not be, that's kind of pushing it, right? There's those like,
Right.
yeah. The thing I'll say on this is that when you're a business owner or you own rental real estate, you are a business owner, you're going to be entitled to deductions that are going to help you reduce the taxable income related to that business. Take those deductions. But that doesn't mean you can write off everything under the sun. Doesn't mean you can write off your personal cell phone unless you're using a percentage of it for business, right? Doesn't mean that you can write off your haircuts. Doesn't mean that you can write off because you need to be on, a picture for something. It just, there's legitimate stuff and then there's stuff that you're trying to force into being
Yeah.
legitimate. And that's where the gray line is, or that's where you're kind of getting to the edge of the line.
And honestly, I've seen women in our inner circle have issues with that because they have taken too many deductions and then now and it's lowered what their income is. So then that way they go to get certain types of loans
Yeah.
and then they get denied because they have too low of an income because they took too many deductions that they were not entitled to.
Yeah.
So I hear what you're saying. There's a difference between what is a true business expense versus what is kind of pushing the line of abuse there, but that can have then ramifications on scaling your portfolio.
Yeah, yeah, and one thing I will say is that there's some lenders out there. So we get this a lot. Unsophisticated lenders don't understand depreciation. They'll like deny a loan, but if you're working with lenders who understand depreciation, who understand real estate, they're going to add back the depreciation. Now, to your point, if you're just deducting everything in the kitchen sink frivolously,
Literally.
yeah, then they're going to look at that and say those your expenses are too high, right? We're not going to lend to this because of that. But you shouldn't fear depreciation. That's something that often comes up with lenders. Most lenders who understand the space will add that back for you.
Thank you. All right. I think the last topic I want to discuss here with you today is, let's imagine right now it is like December 1st. From other CPAs I've talked to, and I'm not saying I've ever done this, but a lot of people tend to call their CPAs at the very end of the year and are like, oh my God, my tax burden is going to be high. What can I do to lower my tax burden? And most CPAs are usually like, you should be thinking about these things throughout the entire year,
Mm.
not
Yeah.
within the last 30 days of the year. So we are in the middle of the year now. What are some things that we as real estate investors should be thinking of doing or setting up and organizing now rather than December 1st?
Right. Okay, that's a great question. So there's a bunch of things. So the first thing is you should have a bookkeeping system in place throughout the year. So you're capturing your expenses, you're having documentation of your receipts, and you're not waiting until December 1st or January 1st saying, okay, looking back at all your financial records, trying to piece together what happened throughout the year. What was a deduction? What was a personal expense? That's one thing that you want to get that going throughout the year. It doesn't have to be every month, maybe be once a quarter, but it's something you don't want to wait till the end of the year just to do. Second thing is going to be, if you are going to qualify for the real estate professional status, you want to keep a contemporaneous time log. So keep the time log throughout the year. Don't try to sit down on December 1st. Remember everything you did for the year. It's going to be very challenging. I used to have to keep time as an accountant, and it's hard to remember what you did last week, let alone, 6 months ago. So I'd say keep that time log throughout the year. That's going to be something you want to do. If you are going to be purchasing properties and you do want to place them in service and you do want to take advantage of the tax benefits on that specific property for this year, normally the sooner you do it, the better. If you wait till December 1st to purchase that property, it's going to be challenging to do that. Vehicle purchases, if you do need to purchase a vehicle for your business or your rental portfolio, waiting to the last minute does have its benefits, but waiting too close to the last minute can also be a detriment. So you want to plan for that. I'm trying to think, because oftentimes what happens is when people come to us at the end of the year, they're looking for like the scraping the barrel in terms of like doing last minute
Yeah.
purchases that they may not need to reduce their tax liability, not setting them up for true tax strategy. For example, someone might have qualified for the real estate professional status and they could have set that up had they started doing it in July, for example, or earlier. But now if you're in December, the year's already passed. You can't change the facts and circumstances of what happened from the year. Or same thing with short-term
Right.
rentals or just like any number of strategies. So I'm trying to say is like at the end of the year, there's very few things you can do besides just purchase stuff, right? That you may or may not need. But if you're proactive, sometimes this year or even many years in advance, you could set up yourself to put yourself in a position to take advantage of some of the strategies and deductions that we've been talking about.
And honestly, I think to kind of come full circle here, I feel like that's why it's really important to find the right CPA, the right firm, the right people to work with to set up those things rather than just, hey, I have to file my taxes by April 15th when running real estate investing as a legitimate business.
Right. 100%.
All right. I'm going to give you 1 second here. Anything, if you were on your soapbox as a CPA, any message motto that you feel like a message that we should all hear before we sign off on
Yeah,
today's
yeah.
episode?
When you are committed to being a landlord, you are now entering a business. You are now graduating into a more sophisticated way of doing things where you have a lot more responsibility to make things go, right? Like you kind of mentioned before, you need the right people and the right seats around you on your team. You need the attorney, you need the accountant, you need the insurance agent, you need the property manager, perhaps you need these other pieces around you. I think when people go from W-2 into just like a business like this, they don't realize the cost of doing business and surrounding themselves by a team of people that are specialists are going to be able to help set you up. I think when you're making that transition, you have to realize you're graduating to a different way of doing things, and having the right people on your team is critical, and that includes a CPA, right? So if you're going to be growing a rental portfolio and you're using H&R Block and TurboTax, there's a chance that you're leaving money on the table or potentially making mistakes that could cost you money. So That's going to be my biggest thing. Just realize that you want to get the help that you need for as you kind of get into this more sophisticated space rather than going with the cheapest option just because, that's what you've maybe always done. I think it's the biggest thing I can leave you with people when it's the
Thank you.
mindset shift of going from non-business owner to a business owner.
Right. And that's really what being a real estate investor is. And I think that's really important to point out. So I'm glad you did mention that here. Thomas, thank you very much. I appreciate your time today. I will put your contact information down in the show notes as well. So ladies, if you would like to reach out to Thomas to talk about your situation or have any other follow-up situations from this talk, feel free to please reach out to Thomas. Otherwise, Thomas, thank you for being here. Ladies, please do make sure to hit that subscribe button so you do not miss the next episode of the Lady Landlords podcast. And I will see you all back in the Lady Landlords Facebook community.
Thank you for listening to the Lady Landlords podcast. If you're feeling stuck in your real estate investing journey, visit lady-landlord.com to book a 15-minute orientation call with me and see if you're ready to join our mentorship program. Or you can subscribe to our newsletter and join our Facebook group for exclusive real estate investing tips and offers. Invest with confidence. Become a Lady Landlord today.